gold has actually done so well, and it's partly because geopolitical risks, that it's now larger than the S&P 500 in terms of market cap. So the S&P X Mag 7 is actually smaller than the gold market. And as I've said before and many times in the past, a continued rise in precious metals is not sending a great signal for equities.
Bitcoin is the first global, digital, private, meaning no government oversight, rules-based, most important part of it, monetary system in history. That is a very big idea. Now, what has happened in the last year or so, stablecoins have been usurping one of the roles that many of us thought Bitcoin would play.
Gold's total value has now flown past the S&P 500, powered by geopolitical stress that keeps pushing investors toward the ultimate safety blanket, leaving equities gasping for momentum. Analysts argue this gold-first instinct marks a psychological shift, the kind that reshapes entire cycles. At the same time, stablecoins keep tightening their grip on emerging markets, regions many once assumed Bitcoin would dominate. Yet survival instincts trump ideology when currencies wobble and stability becomes the only currency that matters. Even so, ARK Invest CEO Cathie Wood continues to champion Bitcoin as the world's first truly borderless, rule-based digital cash network. But Bitcoin's mood is far from triumphant. Recent price action reflects a market under pressure, now grinding in the mid-60,000ers and flashing warning signals, weakening momentum, declining liquidity, and miners offloading more aggressively to survive tightening margins. Prediction models circulating online warn that bearish conditions could drag into 2026 if macro shocks persist, with some analysts floating bottom targets between $30,000 and $45,000. ETF flows, once a rocket booster, have cooled sharply, several days even flipping negative, suggesting big money is stepping back to reassess the storm. Exchange reserves are climbing, a classic sign of sellers preparing their exit lines. Still, financial analyst Tom Lee argues these shaky stretches are the prelude, not the finale. And paired with Wood's long-range vision, the narrative turns into a tension between short-term fear and long-term conviction. This points to a pause before gold might spark Bitcoin's next run. The link stays weak at 0.14 since 2019, but past cycles say it catches up. Tom Lee and Cathie Wood break it down, explaining why things feel shaky even with AI and crypto buzz, pitting short-term wobbles against big money and tech changes. Let's watch clips from Tom Lee's speech to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
I think there's 7 reasons why it feels like a bear market at the moment. Year to date, the S&P is up 1%. And as you can see, looking at this chart, it is a little jaggedy, but the trend is higher. But here are the reasons why I think it feels like a bear market. First is that gold has done so well that it's created FOMO, or fear of missing out. Here's the thing. Gold has actually done so well, and it's partly because geopolitical risks, that it's now larger than the S&P 500 in terms of market cap. So the S&P X Mag 7 is actually smaller than the gold market. And as I've said before and many times in the past, a continued rise in precious metals is not sending a great signal for equities for multiple reasons, but part of it, of course, is it's a vortex for risk appetite. The second is there's been a rotation in what I call armies versus bullets. The armies are the Mag 7 and the bullets are the AI suppliers. As you can see, markets have rotated from favoring armies, which are the companies that have great businesses, to the arms makers. But here's the thing. We've now created a valuation discrepancy. In the past, the armies always traded at a premium to the bullet makers. But as you can see, in 2026, that has flipped, and now the armies traded at more than a 3-point PE discount to the bullet makers. Does that make sense? I don't know. But here you go. You can see, if you look at the bullet makers, semis, power generation, and infrastructure now trade at higher PE multiples than the Mag 7. I think there's going to be a rotation back later this year, and so you have to be mindful of that. The third is that AI continues to be roiling sectors. It's, I guess, AI rampage. the latest being software. And keep in mind, people had talked for years about software eating the world, but now AI is eating the software industry. And so I think investors are taking a fire aim ready approach, meaning they're first selling everything before they decide if they actually want to buy anything. And keep in mind, there are AI resilient stocks out there. So software has fallen to the lowest prime brokerage exposure ever, according to Goldman Sachs. Crypto's also been under pressure. A lot of that has to do with the outperformance of gold and risk appetite. The Fed with the new Fed chair, the market's trying to understand this new Fed chair, and I'll talk about it in another video, but the market always tests a new Fed chair as well. Tangentially, keep in mind the Epstein files, I think have continued to sort of remain a headline story, and it's creating a lot of high profile embarrassments. And of course, most recently, private credit is again resurfacing because of some of the concerns about companies like Blue Owl, and people believe there's echoes of the GFC. Now, something that is roiling markets, but I don't think it's making it feel like a bear market, is the tariffs. The Supreme Court, not surprisingly, overturned Trump's tariffs. And President Trump, in turn, is actually implementing, well, originally a 10% tariff, but now it's 15%. And he has authorities to actually levy tariffs, so it's not like it's going away. So now let's talk about the granny rebalance, because that happens every 3 months, and we just had the latest rebalance. Okay, this was executed on February 18th, so it happened last week already. Now let's start with granny. This is both granny and granny income. The top three sector weights remain in tech, industrials, and financials, but the weighting has shrunk a little bit from 74% to 60%. But what has increased is energy, materials, and healthcare. They were actually zero weights in granny income before, but now they're 8, 7, and 3%. So they've gone from 0 to 18%. For Granny J, industrials, information tech, and financials were originally 74%. They're now 63%. And energy and healthcare were 8% in the portfolio previously, and they're now 16%. So that's really where the changes have taken place. It's energy and healthcare and materials. Now, these changes are not taking place because of the macro themes of energy / cybersecurity, millennials, global labor suppliers, or easing financial conditions. It's really because of style tilt, seasonality, and the PMI recovery shifts. Okay, and these rebalance every 3 months. For instance, in terms of style, previously we were recommending quality growth and quality cyclicals. Now it's actually value quality and quality cyclicals. Okay. And so that's what we think will outperform the next 3 months based on our analysis. These are the top 8 sectors, seasonally speaking: tech, hardware, semis, ground transportation, aerospace and defense, life science tools, metals and mining, oil and gas consumables, and biotech. You might think these have already done well. That's true, but this is the seasonal pattern. And that leads to both deletions from our portfolio, which were done on February 18th, and additions. So let's look at the additions. Chevron, this is for large cap. Chevron, Union Pacific was added. Texas Pacific Land Corp, One Oak, Amgen, Air Products, Packaging Corp, PPG, Northrop Grumman. Now on SMID Granny, there were a lot of 11 removals, which is a lot, and 18 additions. Okay. So Carpenter Technologies, Curtiss-Wright, Exelixis, Halozyme Therapeutics, Valmont Industries, Array Technologies, Fabrinet, Hyatt Hotels, Domino's Pizza, Elf Beauty, Carrier Global, United Health Services, HF Sinclair, Huntington Ingalls Industries, DT Midstream, Energy Fuels, Lattice Semiconductor, EchoStar, and that's it. Now, let's talk about Granny stock performance. And rather than talk about the individual names, I want to talk about the themes that outperformed this week. Number 1 was energy and cybersecurity. Number 2 are millennials. And number 3 is the PMI recovery.
Bitcoin now sits in the middle of a global reset as geopolitical tension pushes investors toward hard assets and drains confidence from traditional equities. Gold's dominance has altered risk appetite across markets, but Bitcoin's challenge runs deeper, thinning liquidity, shifting regulations, and an institutional crowd that has slowed its once aggressive accumulation. What should have been a momentum-driven cycle is instead turning into a test of conviction. Yet Tom Lee insists this cooling period reflects the same early cycle reset Bitcoin has seen before, sharp pauses that precede sharper expansions. Meanwhile, Cathie Wood continues to champion Bitcoin as the only global, politically neutral monetary system capable of thriving even when traditional markets wobble. And despite the softer tone, long-term holders, miners, corporate allocators, and infrastructure players continue strengthening their positions beneath the surface. With capital rotating defensively, institutions hesitating, and Bitcoin quietly tightening its foundations, the market feels like it's sitting on a hinge, one that could swing dramatically in either direction. So the real question now is, in this tightening, uncertain landscape, is the Bitcoin market gearing up for breakdown, or quietly building the base for its next breakout? Let's now turn our attention to Cathie Wood.
Is this just another volatility cycle investors must deal with, or a fundamental regime shift?
Well, I can talk with some experience. I was in the bubble, investing, portfolio manager during the bubble. And what we witnessed back then were investors throwing money at any company with .com or internet in its description. Today couldn't be more different. We are climbing a wall of worry. Investors are very hesitant to continue fueling the AI boom because they're worried that we are in a hype cycle. As a portfolio manager, I would much prefer to invest in that kind of market. Why? Because walls of worry, climbing walls of worry, those are the most durable bull markets. And I remember as way back in the 80s and 90s, those were the kinds of bull markets we were in. In the late 90s, that was an irrational, out of control end to a massive 20-year cycle.
And in general, where do you see the most compelling opportunities within the artificial intelligence industry right now?
Well, I would have to say that the opportunities are more in embodied AI, meaning bringing the physical and the digital together. And so autonomous mobility, we think, will be the biggest revenue generator. It'll scale the most quickly to the $10 trillion mark, which is quite meaningful in a world where global GDP is about 130 trillion. We think that will happen within the next 5 to 10 years. And this movement has happened slowly, and now it's happening all at once. Elon Musk was talking about autonomous mobility in his master plan 12 years ago. And here we are. Finally, he launched this year. So slowly, and now he's saying by the end of this year, depending on the regulatory environment, Tesla will be autonomous in 25 to 50% of all of the U.S. major cities. So that's one. And then the other one is in healthcare. While we may see the scaling of revenues the most quickly in autonomous transportation of all kinds, we think the most profound applications of AI are going to be in healthcare. And from a regulatory point of view, here in the United States at least, we're just strangling the healthcare sector, and with too much focus on safety and not enough on efficacy.
The overall impression is that the market narrative around Bitcoin has shifted compared to a few years ago. And that's probably because it trades like high beta tech stock. So do you still consider it as a longer-term monetary asset? And if so, What is the market misunderstanding?
Yes, we do believe, and our conviction has increased, that Bitcoin is the first global, digital, private, meaning no government oversight, rules-based, most important part of it, monetary system in history. That is a very big idea. Now, what has happened in the last year or so, stablecoins have been usurping one of the roles that many of us thought Bitcoin would play. In the emerging markets, people who are living hand to mouth, meaning they don't have a lot of savings, they would much prefer the dollar. And stable coins are backed pretty much 100% by dollar or dollar-based assets. And so that is their preferred insurance policy against their own currency's devaluation and the loss of purchasing power and wealth. So from that point of view, in our long-term forecast, which our bull case for 2030 has been $1.5 million, that would have taken $200,000 to $300,000 off of that price target. But what else has happened in the last year? We've seen gold really go parabolic, and Bitcoin has not done the same. Well, how can that be? It's digital gold, we thought. Well, if you look at the correlation between gold and Bitcoin, you'll see it's very low, especially since 2019. Since more traditional investors have been getting involved with it, the correlation is 0.14, so almost no correlation. But if you zoom out and you look at the longer term price chart of Bitcoin, what you'll see is gold often leads, and certainly in the last two cycles, Bitcoin's performance. So gold is a leading indicator in at least the last two cycles. We think the other thing going on is we're seeing a lot of OGs selling. Those who were very early adopters of Bitcoin are selling. Now, why are they selling? Well, according to some of them, Bitcoin has lost the plot. Too much traditional finance or financial players are getting involved. And from our point of view, all along, and this is in our collaboration with Dr. Arthur Laffer, known for the Laffer curve, he has said the more that Bitcoin becomes involved in the traditional financial ecosystem, meaning traditional financial institutions start adopting it, the stronger his conviction will be that it is indeed the new global monetary system I described. So our conviction has actually gone up as Bitcoin has gone down here.
Cathie Wood draws from her bubble-era portfolio management days to contrast today's market with the late 90s dot-com frenzy, where investors chased any internet-tied name. Now, she says, we're climbing a wall of worry, with hesitant funders questioning the AI hype cycle, yet such skepticism fuels the most durable bull markets, like those in the 80s and 90s before the irrational late 90s blow-off atop a 20-year cycle. She spots compelling AI opportunities in embodied AI, blending physical and digital worlds. Autonomous mobility stands out as the fastest scaler to $10 trillion, huge against $130 trillion global GDP, within 5 to 10 years, accelerating from slow progress. Elon Musk flagged it in his master plan over a decade ago, and Tesla now eyes 25 to 50% autonomy in major U.S. cities by year-end, pending regs. Healthcare, though, promises AI's deepest impact by slashing drug discovery costs from $2.4 billion, failures included, to $600 to $700 million and timelines from 13 to under 8 years, despite U.S. regs overemphasizing safety over efficacy. For hand-to-mouth folks, dollars and stable coins, 100% dollar-backed, beat local currencies as hedges against devaluation. Wood's 2030 bull case Bitcoin target hit $1.5 million, later trimmed to $1.2 to $1.3 million amid gold's parabola outshining Bitcoin, despite low 0.14 correlation since 2019. Gold led the last two cycles. OGs sell citing TradFi encroachment, yet per Dr. Arthur Laffer's LER curve collaboration, institutional adoption bolsters Bitcoin as the new global monetary system, hiking her conviction. Recent price action highlights space/defense tech strength, mirroring AI gains. Her ARC-I, AI and robotics fund excelled but corrected, presenting a buy the dip, while genomic fund ARC-G lags amid skepticism, underscoring healthcare AI's drug revolution potential. With gold now bigger than the S&P 500, do you think Bitcoin will follow its lead and surge higher soon? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching. Please don't forget to like and subscribe.